How does inflation affect stock market? After more than 10 years of low inflation, we have seen a surge in inflation. A myriad of factors has converged to trigger inflation, including pandemic-related lockdowns, a massive monetary and fiscal stimulus and supply chain disruptions. Here's an overview of how inflation affects equities and what kind of investing style does best during investing. What is inflation? Inflation occurs when prices for goods and services go up across an entire sector over a significant period of time. The most widely used measure of inflation is a rate called the Consumer Price Index, or the CPI. The most widely cited measures prices without including energy and food. This is because energy and food prices tend to fluctuate far more dramatically than other goods and services. One cause of inflation is a large expansion of the money supply. Normally the Federal Reserve expands the money supply, which includes outstanding currency and liquid assets. From 2015 until March 2020 it expanded the money supply between 3% and 5% each month. But in March 2020 it began expanding the money supply approximately 20% each month. By August 2020 the Fed had expanded the money supply by 9.24%. Heavy expansion of the money supply continued until March 2021, at which point the central bank started trimming such increases. Several other factors besides expanding the money supply are associated with inflation, including a growing economy, increased regulation, supply chain disruptions and exchange rate fluctuations. After a massive fiscal as well as monetary response to the pandemic, economic demand that had been pent up due to lockdowns was unleashed, and in 2021 it began soaring. By February 2022, inflation had jumped to 7.9%, the highest in 40 years. How does low inflation affect the stock market? The stock market is a continuous mechanism for evaluating current economic conditions and discounting future conditions. The ideal scenario for the stock market is to have a sustained period of low to moderate inflation, 1% to 3%. This is good because it means the economy is not overheated, there is demand for goods and services that is healthy, the prices of goods and services tend to be rather stable and the eroding value of each dollar is acceptable. Inflation erodes the value of income, savings, investments and money overall. When inflation is high, as it is today in the US, the consumers lose a larger portion of their buying power. They need more money to buy the same amount of goods as compared to the past. For example, high oil prices have made transportation costs increase significantly. In a period of high inflation, companies must pay more for raw materials, moving goods and running their factories. Of course, the companies can increase their prices of goods and transfer some or all of the impact of inflation to the consumers. Still, higher prices are not treated favorably by consumers. High inflation, in a nutshell, causes a lot of uncertainty. As consumers must make more careful decisions on their spending habits, retail sales could slow down, and in the US market, a slowdown in retail spending is very bad news. It can lead to lower economic growth. Lower economic growth will be negative news for investors, and chances are the stock market will be weak when inflation is too high. This explains the stock market performance in 2022. Do stocks go up or down during inflation? When inflation is low, the cost of money is also low, and growth stocks in theory should perform better than value stocks. On the contrary, when inflation is high, value stocks should perform better compared to growth stocks. But valuation concerns in a period of high inflation push the stock market lower. The bad news is that high inflation takes time to return to a normal range. Inflation is near 8% in the US, the normal range of inflation is 2% to 3%, so the Federal Reserve will have to increase the key fund rate to try to tame it. Using a higher risk-free rate in a discounted cash flow model to value stocks, means that the valuation of equities is driven lower. Lower valuations mean that there must be a gradual rebalance between observed stock prices and their intrinsic worth. The downside is the most logical path for the stock market. Higher inflation increases the cost of money and capital. Companies that have a high level of debt are worse off in an environment of rising interest rates. This explains why high-growth stocks, companies that have debt, suffer when inflation is high and interest rates are rising. High inflation makes the stock market more volatile. The stock market is already volatile in 2022, and it should get even more volatile as higher interest rates come to pass. High inflation can make nominal returns negative. For example, assume you have a return of 5% to 6% in your stock portfolio. When you consider inflation is at 8%, the real return, where you subtract nominal return from inflation, is negative. This makes stock picking in a high inflation era more important than when there is low inflation present. The chance of a recession, 2 consecutive periods of negative economic growth, is likely when inflation is very high. This may turn investor sentiment to risk-off mode, as it should, and therefore cause a shift of investing style. I would argue that high-dividend stocks are a safe choice when inflation is high, as they compensate with generous passive income for the loss of purchasing power. In the end, high inflation is not only bad news for the stock market but is an unsustainable economic condition that can derail the growth and strength of the economy. To the extent that businesses do not pass the inflation to consumers, this means lower profitability, and therefore high odds of lower stock prices. So in sum, high inflation spells a lot of trouble for the economy and the stock market. How to respond to inflation? Inflation should cause investors to consider, or reconsider, both their investing style and the specific types of securities in their portfolio. Value investing. The investment style that tends to do relatively well during inflation is value investing. Unlike growth investing, value investing entails the practice of identifying and buying whose intrinsic value, as determined by fundamental analysis, significantly lags their share price. Value stocks often have a relatively low price-earnings ratio and strong free cash flow. For more than a decade, growth investing has outperformed value investing. That's attributable to the Federal Reserve's easy money policy. In December 2008, the Federal Reserve dropped interest rates to near zero and kept them there throughout the recovery from the global financial crisis. It wasn't until December 2015 when the Federal Open Market Committee hiked the target federal funds rate above the 0% to 0.25% range for the first time since December 2008. During this time, the Federal Reserve also expanded its purchase of longer-term securities in an effort to bring down longer-term interest rates and increase economic activity. While the target rate steadily rose in subsequent years and reached 2.25% to 2.50% in late 2018, the low-interest environment returned at the onset of the COVID-19 pandemic. The Federal Reserve slashed rates twice in March 2020 in response to the economic turmoil the pandemic unleashed, dropping the target federal funds rate back between 0% and 0.25%. It's remained near zero since then. But with as many as 3 Fed rate hikes expected in 2022, the era of easy money may be over. That's bad news for growth stocks but good news for value stocks. Well, thank you so much for watching. If you enjoyed today's video, please give it a thumbs up and subscribe our channel for more content like this.